the best of Money Matters.
Market View on Money FM 89.3.
You're tuning in to Money FM 89.3. Time now for Market View with me, Chua Tian Tian, where we take you through how the Singapore stock market ended the day, the biggest movers, sectors, and of course the companies to watch. But as always, a quick recap of some key movements for today. Well, Singapore shares rose as investors continue to digest more developments on the global trade front. So if we look at the Straits Times Index, it was up 0.41% at 4,074 points at about 12:01 p.m. Singapore time, and we're looking here at a value turnover of 564 million Sing dollars in the broader market. Now let's take you through the closing numbers. As we shared with you earlier, the STI closed up 0.44% at 4,075 points. In terms of value turnover, we're looking at 1.23 billion Sing dollars at the close. Gainers outnumbered losers 324 versus 175. Top advances for today, we've got here UOB, SGX and DBS. And top decliners, we have ASUS, GMHUSD and Tan Chong International Hong Kong dollars. Well, in terms of counters to watch, we have DBS, Singtel and ST Engineering, given how the three companies were among the top performers in Temasek's Singapore-based portfolio companies in the past year. Now, elsewhere, from Nvidia's brief rise to a world record $4 trillion USD valuation, to the latest US Fed Reserve meeting minutes suggesting that there might be rate cuts later in the year. We've got more corporate and international headlines in focus. And also on deck, US President Donald Trump's latest tariff salvo, this time on Brazilian imports. Well, lots to watch, and joining me on the line on a Thursday is David Chow, Director of Assure Capital. David, welcome back to the show.
Hi, Nindian. Good after 1 week of absence. Certainly good to be back.
Yeah, and a lot of things to watch in the time since. More news from US President Donald Trump. Not only did he announce a new 50% tariff on copper imports, he also slapped a 50% duty on goods from Brazil, both levies kicking in on the 1st of August. Now, in the meantime, out of the US as well, we've got minutes from the latest Federal Reserve meeting, suggesting that rate cuts would be appropriate later this year, even though officials remain split. So how have markets around the world reacted to the news in totality? Asian investors seem to have brushed off Trump's comments. What do you think?
I think the global market reaction, has been mixed, but generally muted. I know with Asian markets showing particular resilience, and let's assess the impact on a few fronts. So if you look at the US market since the announcement, I think it has demonstrated limited movement in response to the latest tariff announcements. I think investors are still awaiting clarity on more of Trump's tariff threat, suggesting a cautious approach rather than a straight sell-off. The S&P 500, for instance, has been relatively stable, with the index closing nearly flat after a day of assessing tariff developments. And if you look at moving on to U.S. Treasuries, the yields have not seen dramatic shift in response compared to what took place in April. And I think the latest tariff news appear to have been absorbed without significant disruption to the bond markets, possibly due to the Fed's minutes suggesting that tariff-induced price shocks will be temporary. I mean, if you can trust their assessment. And finally, on commodities, the 50% tariff on copper imports, I think, contributed to fresh chaos in metals, but that's muted as well. Contrast that with earlier market reactions to Trump trade policy, which saw commodities like copper and oil, slide due to fears of reduced demands. So with that being said, Asian markets are still up and running, and I think the resilience in Asian markets may stem from ongoing trade negotiations still, and tariff pauses with countries like China and Vietnam, which have mitigated some of the immediate economic fallout. So, we are likely to see that the market continue to proceed cautiously, but, it may go up or down depending on what Trump says.
I see. Now, David, let's stay in the U.S. Nvidia launched a market capitalization of $4 trillion US dollars, or around 5 trillion Sing dollars, in Wednesday's session, making it the first public company in the world to reach the milestone, of course solidifying its position as one of Wall Street's most favored stocks. How would you read into the news? And the question for you, as always, how far is the ongoing AI boom a bubble, looking at valuations right now?
okay, by reaching this new milestone, I think it went from 2 to 3, and every time, a question arises, so what happens now?
Yeah.
And by reaching this latest milestone, it really underscores, again, Nvidia's dominance in the entire AI ecosystem. I think I came across an article earlier stating that, Nvidia now is worth materially more than the combined, value of all the publicly traded companies in Germany. Itself, already one of the biggest economy, as we know. And at one point, this morning, when its market cap, top 4 trillion, it's around 30% above the valuation of the entire German stock market as a whole. Yes, I mean, we have to admit that Nvidia is the poster child of this AI revolution, and that promise, investors are still willing to pay around 38 times forward earnings for its shares, and they are also paying nearly, I think, 50 times its book value, about 10 times as much as they are willing to pay for the entire S&P 500 as a whole. So while Nvidia has immense potential, yes, we agree, it's really priced to perfection, meaning a downside surprise could, potentially cause a material fall in its share price. I know that, we have one camp of investors who love to use a price earning as their favorite metric for valuing Nvidia. They are saying that, despite its 4 trillion market cap, Nvidia's valuation is considered still relatively reasonable by historical standards, trading, below its 10-year average or PE ratio. So what would be its 10-year average PE ratio? I think, if I'm not mistaken, I think it's a high of 55.2 times and a low of about 28 times. So the current 38 times is not, overly high based on a historical perspective. But, we have to remember that Nvidia share price only took off at, end of 2022.
Yeah.
And that's too short a time to be using a 10-year average. And, looking at Nvidia's current market cap now, it's also nearly double the projected 2024 global semicon industry revenue, again raising questions about sustainability. And I think if I drill down its last set of financial statements, I could see that its accounts receivables have ballooned to 53 days, potentially indicating stretched financials to meet targets. They might be forcing more chips to their customers, in a bid to raise their revenue. I'm just saying it may or may not happen. Mm-hmm. So with this, at this point in time, I think investors have to be more wary of what's happening with Nvidia and the AI industry in general in order to make a more informed decision on whether to still invest in Nvidia at this stage. And of course, if the entire AI industry is still booming and Nvidia could continue to grow its earnings, I think it won't be long before we continue with the thesis of Nvidia's re-rating again. Yeah. And if you ask me on whether there's a bubble currently, and yes, you have asked me a lot of times, I think at this present moment, we still believe the current boom should be viewed as a multi-decade trend, similar to the smartphone evolution. And we could see that on our side. There's a real demand for AI products, which distinguish it from the dot-com bubble years ago, but do be wary of potential disruption. And just inferring from TSMC's June quarter results earlier today, I think revenue rose better than anticipated 39% year-on-year. So this will be continue to support expectations of a boom in AI spending.
Okay, and if we go back to the Singapore stock market, David, how did the STI fare today? Any surprises when it comes down to the biggest movers?
I think I mean, again, this is yet another session where our local stock market has, made new highs. And I think if you ask me, I think a few weeks ago, what would be my price target? I actually said 4,000. But with STI now closing 0.4% higher up to 4,075, I would say we could be reaching 4,250 mark in a few months' time. But with, it's a big but, I think we're likely to see some forms of consolidation going forward before we actually hit this target. And in terms of the biggest movers today, I think we could see the likes of our local construction counters like Hong Leong Asia, Soy Build Construction, closing 5 to 7% higher. I think we think this is a positive move as investors have shown interest in industries which have positive catalysts in the form of higher overall construction spending for the construction guys this year and possibly the next. So we would like to see that happening. Besides seeing the share prices of the STI index member being pushed up, but looking ahead, I think we still remain cautiously optimistic about the second half this year. While valuations have risen for the index as a whole, I think we could see that Singapore blue chip stocks continue to offer attractive yields and defensive characteristics. So sectors like engineering, financial, and real estate are expected to remain in focus. And with the STI, as I said, likely to consolidate at higher levels. So we have to see whether this global economic headwinds intensifies or not.
Okay, and now let's take a look at some of the companies to watch for today, David. We have DBS, Singtel, and ST Engineering. All three companies were among the top performers in Temasek's Singapore-based portfolio companies in the past year. What do you make of the news, and really what is the outlook for these companies in your opinion?
Right. I think for the past year, I think ST Engineering will be the one out of that three companies that stood out. It rose 90% for the past year. Followed by Singtel and DBS. So I think year to date wise, I think ST Engineering has continued to reward its investors and shareholders. And I think just a shade off will be a DBS, which is up just 4+% this year. I think we could see investors, begin to rotate their funds into other sectors, and this is what we truly want to see. For the local market, we not only want to see the local index members going up, but the positive vibe should be rubbing off onto other companies as well. And for that, we also seen the likes of Bukit Sembawang, Gocholand going up as well. So going back to these three companies, I think for ST Engineering, the company's ability to really secure large-scale contracts and expand internationally, as well as innovation in high-growth segment, has really made it a very strong magnet for both institutional and retail investors. So I think we could likely see a trend whereby, as global defense spending rises, and this is mirrored by defense spending ETF in the US that has been rising as well. I think ST Engineering is also poised to benefit from its diversified business model and strong order books, which provide both growth and resilience. And this explains its outsized performance in the local market. For DBS, I think we see a steady growth ahead. With risk perhaps tilted a bit to the downside. And lastly, for Singtel, we remain optimistic on the counter with three catalysts, namely the narrowing of the holding company discount to hopefully 20 to 25% from the current 25 to 30%. The second catalyst will be ramping up of its data centers in both Thailand and Singapore. And lastly, we continue to see improvement in hopefully in Optus in Australia that will continue to support its share price.
Okay, and David, across the region, South Korea's central bank held interest rates steady today as policymakers steered this cautious path amid concerns about financial stability risks stemming from rising household debt, as well as economic pressure from U.S. tariffs. So the BOK's board, a monetary policy board, voted to keep its benchmark interest rate unchanged at 2.5%, in a move that's widely expected by economists. What does the move mean for South Korean equities and the Korean won? Very quickly.
Right. I think this move reflects a largely cautious approach amid rising household debt and U.S. tariff pressure. And I think the decision to hold rates steady really signals the BOK's their priority of financial stability over immediate growth stimulus. I think, again, due to concerns about accelerating household debts and the South Korean housing market. So I guess the BOK is awaiting the impact of its new mortgage rules before considering further easing, and this cautious approach, may dampen investor enthusiasm in the short to medium term, as market often rally on expectations of rate cuts. I think the Kospi is likely to remain range bound or experience, muted gains in the near terms as investors, weigh tariff risk, and the absence of fresh stimulus by the offered by the central bank.
Yeah.
And if I look at the central bank signal of a potential rate cut at its next meeting, possibly in August this year, again, this will then provide the catalyst for equities, especially if tariff uncertainties at that time could ease, or if fiscal stimulus is actually introduced, post the June presidential election. But do be wary that BOK has previously downgraded, I think 2025 South Korea forecast to about GDP forecast to 0.8% from 1.5%.
I do want to end off with what's going on with OpenAI because OpenAI is reportedly close to releasing an AI-powered web browser that will challenge Alphabet's market-dominating Google Chrome. Now, what do you think such a move would mean for Alphabet? Of course, now as per a Reuters report citing sources familiar with the matter, but if it turns out to be true, what would such a move mean for Alphabet? How realistic is it for OpenAI to compete?
I think I think for Google Chrome, with over 3 billion users and holding about 60 plus global market share in both, I think desktop and mobile, is it's a cornerstone of Alphabet's ad-driven business. Again, this accounts for nearly 3/4 of its revenue. So if an open AI browser, especially if adopted by a significant portion of ChatGPT's reported, I think 400 to 500 million weekly active users, could disrupt this data pipeline. By offering an alternative browser, I think OpenAI could capture user data directly, hence reducing Alphabet's ability to target ads effectively. And this could really pressure Alphabet's 200 billion of ad revenue stream. And when I see that the structure of the OpenAI's browser is designed to integrate AI agents like operators, which enable tasks like booking reservations or filling out forms directly within the browser, potentially reducing reliance on traditional search engines. So such user interactions may stay within a ChatGPT-like interface, again bypassing Google search. So the threat is definitely there. So how realistic is this OpenAI in competing with Google? Well, I think Google Chrome, which still holds over 2/3 of the global browser market, followed by Apple Safari at about 16%. I think to really kick Google Chrome down is really an uphill task for now. OpenAI's browser will need to offer a radically better experience to shift user habits, as browsers are sticky, due to your familiarity, your extension, and your entire ecosystem integration. So again, OpenAI isn't alone in this space. We have heard, AI startups like, Perplexity, and have all launched AI-powered browsers capable of doing the same. So I think this space is going to be quite competitive. So we will see what the launch like, in the coming days or weeks.
I see. Certainly setting our sights on that. Thanks so much for the insights, David. That was David Chow, Director at Azure Capital. Thank you so much for joining us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.